Today I'm going to show you exactly how to do real trading research. You'll learn exactly how to tell the difference between tradable information and noise, how to connect that information to what you're seeing on an option chain, and how to avoid the traps that stop most trades before they even begin. So to start off, let's talk about what makes information valuable, because not all information is actually worth trading on. In the market, we call information that is truly actionable tradable information. And that is defined as the kind of information that is either unknown to the market or not fully priced into what the market is expecting. Identifying tradable information is what truly gives you an edge. The opposite of this is non-tradable information. And this actually includes all of the news and facts that are publicly known. If you see a piece of information that says, hey, this stock is really good because of ABC reasons. Well, everyone else knows that information, and today's price actually reflects that knowledge. And this is why you can't just read headlines and expect to find an edge. Even if the news is saying that a stock has a bunch of positive catalysts coming up, if you agree with these catalysts and believe they will come true in the way the market expects, well, even when they do happen, today's price reflects the likelihood of those deals going through, the likelihood of these events occurring. And if it was highly likely, then today's price actually already reflects this happening. And this is why you'll see people complain sometimes, oh, they secured this amazing deal. Why did the stock price not change? And well, it's because the market already knew this information and today's price reflected it. So how do you tell the difference between tradable and non-tradable information? Well, tradable information has a few key characteristics. Number one is that it might not be well known. Maybe you discovered some correlation that other people aren't seeing, for example. Tradable information could also come from structural inefficiencies. An example of this could be hedge funds that follow a particular buying pattern when hedging their portfolios. A third way that tradable information could show up is that it's information that is difficult to use. For example, there might be something that everyone knows about, but the execution of it is quite difficult, and that makes it unattractive for people to pursue. Going after that yourself could be a source of edge. Now, another important part, which is often overlooked when it comes to doing good trading research, is understanding why you are observing something. You see, a lot of people will go out there and just backtest a million different indicators until they find the perfect setup that just makes money every single time. And then when they go to actually trade this in the market, guess what happens? It doesn't play out the way they saw in their backtest. Now, this is a very obvious example of data mining, but it happens in more nuanced ways as well. And for this reason, the most important question we can ask when we observe some sort of phenomena is, why is this happening? Here's an example. Let's say you're looking at an option chain for XYZ company, and you observe that the 30-day options have 150% implied volatility, but the realized volatility is just 75%. Options are priced at $10 and they're realizing $5 in fair value. That's a really big gap. You might be tempted to just go and immediately hit the sell button. But what if there was a pending lawsuit for this company and the news is due to come out in the next 10 days? Either the company is going bankrupt or it's going to be smooth sailing moving forward. Well, all of a sudden that IV number and that RV number start to make a lot more sense. Implied vol is really high because a big move is expected in the near future, and RV is low because we're still waiting for the news. We don't know which way this stock is going to go. In this case, we would look at that IV number and say, well, even though the number is high and it looks as if we want to be selling it, we know because we understand why that number is high, and we may want to think twice before just jumping in here. Now, understanding why can also help validate an opportunity though. For example, let's say we're seeing that same situation, IV's at 150, RV's at 75. We dig into why, and we see that a company had just released a bunch of really bad sales data. The sales were expected to be better than any quarter in the past, but in reality, it was just a below average quarter, and we're feeling a little uncertain about the future. When the news came out, the stock took a huge hit, dropping 15 or 20%, and then IV exploded because people felt very unsafe about where the stock will go next. Well, in this situation, we know that the news is already out, people are overreacting to the news and remaining fearful, and all of a sudden, this becomes an opportunity that the why and understanding why the IV is high actually makes this a more attractive trade for us. And this is an example to showcase both sides of the coin. Understanding why is not always about removing your conviction from a trading opportunity. Sometimes it's actually about increasing your conviction in a trading opportunity. The why is an important piece of the puzzle, not just something for disqualifying trades, but also for building our confidence. At Predicting Alpha, the way we think about trading research is as follows. Ideas without data can't be trusted. They're just ideas. But data without ideas also can't be trusted because it could just be a coincidence. You actually need both. You need proof that an idea can make money and an understanding of why the idea should make money in order for you to actually have a good trade idea. Having both of these is what gives you conviction. It's what lets you size trades correctly. It's what allows you to hold them through the noise. And it's what allows you to actually generate a positive return for yourself over a large number of trades. And that's why finding good trades isn't about always being the quickest one to see a price change. Sometimes it's about being the one who can understand why a price change happened. If you can connect data with reasoning, you're no longer just chasing opportunities. You're going to build a system for yourself that actually lasts.